Business is inherently unpredictable. One day you are booking record profits, and the next you are facing a multi-million-dollar class action lawsuit, a massive product recall, or an unexpected corporate restructuring. We know these events will cost money, but we often don't know exactly when or exactly how much. This is where we draw a line between a standard liability and a provision. A typical liability is a present obligation arising from a past event, where we expect an outflow of resources. A provision shares those exact traits, but introduces a specific variable, uncertainty in its timing or amount. That underlying obligation usually takes one of two forms. The first is a legal obligation, driven by strict contracts or clear legislation. The second is a constructive obligation. This happens when a company's past practices or published policies create a valid expectation in the minds of others that the company will accept certain responsibilities. By forcing companies to recognize both legal and constructive obligations, accounting standards prevent management from keeping predictable future costs off the balance sheet. It ensures investors get a complete, accurate picture of the company's financial health. To formalize this, you must pass a strict three-part test to recognize a provision. First, you need a present obligation. Second, an outflow of economic benefits to settle it must be probable. Third, you need a reliable estimate of the amount. Calculating that reliable estimate depends on the scenario. If you are dealing with a large population of items, like thousands of product warranties, accountants use an expected value method, weighting all possible outcomes by their probabilities. If the settlement is years away, that amount must be discounted to its present value to reflect the time value of money. To record the provision, you debit an expense, or sometimes an asset, and credit the provision liability account. When the bill finally comes due and the cash is actually paid out, you debit the provision to clear it and credit cash. Once you establish that provision, it is locked to its original purpose. You cannot use a restructuring provision to absorb unrelated marketing expenses or operational losses down the road. Without these specific rules, a company might be tempted to record a massive, exaggerated expense during a high profit year to create a cushion. They could then release that liability later to artificially boost profits during a lean year. The IAS 37 requirement for a reliable estimate and specific usage prevents this kind of arbitrary earnings manipulation. This strictness heavily impacts corporate restructuring. A private management decision to reorganize doesn't create a constructive obligation. To trigger a provision, the company must have a detailed, formal plan, and they must have either started implementing it or announced its main features to those affected. This visual highlights the built-in asymmetry between recognizing liabilities and assets. For a liability, an expected outflow only needs to be probable, meaning more likely than not or greater than 50%. But if you expect an incoming reimbursement, like an insurance payout, that asset must clear a much higher bar. It must be virtually certain before it hits the balance sheet. Let's test that. Imagine a company faces a probable lawsuit loss of $100,000, and their lawyers estimate a 75% chance the insurance company will cover it. The $100,000 liability clears the 50% threshold, so it gets recognized. The 75% insurance payout fails the virtually certain test. It stays off the books. What happens to outflows that are possible, but fall below that 50% probable mark? These are classified as contingent liabilities. You do not recognize them in the financial statements. Instead, you disclose them in the notes, unless the chance of them happening is remote. If it is remote, you do nothing. On the flip side, we have contingent assets. If an inflow of economic benefits is probable, you disclose it in the notes. You never recognize it on the balance sheet until it crosses that threshold into virtual certainty. IAS 37 is designed to be conservative. The rules force companies to recognize bad news early while demanding absolute proof before recognizing good news. This protects creditors and investors from overly optimistic financial reporting. Let's apply these thresholds to a few real-world scenarios. Case 1. A board of directors meets in late December and decides to close a factory. However, they don't publicly announce the detailed plan to their employees until the first week of January. The private board decision in December is not an obligating event. The constructive obligation only arises in January, when the public announcement raises a valid expectation among the employees. The restructuring provision is recognized in January. Case 2. A chemical spill occurs. The company has a publicly established cleanup policy, creating a constructive obligation, and legal counsel estimates a 30% chance of a related lawsuit. The cleanup costs are probable, so a provision is recognized immediately. The 30% lawsuit risk is only possible, making it a contingent liability that simply gets disclosed in the notes. Case 3. The company is suing a supplier, and lawyers estimate a 70% chance of winning $50,000. Since the inflow is probable but not virtually certain, it is classified as a contingent asset. It is disclosed in the notes, but it does not hit the balance sheet. Looking at this summary table, the rules become a strict checklist. For outflows, greater than 50% means recognize a provision, less than 50% means disclose a contingent liability, and remote means do nothing. For inflows, greater than 90% allows you to recognize an asset, while greater than 50% means you disclose a contingent asset. It is disclosed in the notes, but it does not hit the balance sheet. While we cannot eliminate the uncertainty inherent in these costs, IAS 37 replaces subjective guesses with a rigorous, standardized framework. It ensures that when companies face the unknown, they account for it with consistency and transparency, safeguarding the fundamental integrity of financial reporting.